Welcome to MRII's Insights and Innovators podcast, where we talk to top market research professionals to get their inside stories about innovative and enduring best practices. Today's episode is sponsored by L&E Research. L&E is the expert in qualitative research recruitment with nationwide recruiting, advanced technology, and industry-leading client service to unlock powerful business insights. That's why L&E Research is 99% client recommended. Now, here's your host for today's episode.
I'm Katie Gross, president of Suzy. In today's episode, we'll hear from Mark Simon, partner at Traction Advising M&A. Mark is a visionary executive and strategic advisor with more than 25 years of experience in market research leadership roles and board director positions across leading SaaS companies. He's a strategic advisor in the mergers and acquisitions space and understands how investors see market research companies. So we're going to answer the question, how can founders of market research businesses succeed with their startup? Hi, Mark. So great to see you. For anyone who doesn't know, we go way back to 2008 when I joined Toluna as an account director. And over those years, you were such a great mentor to me. Acquisitions, product launches, and a significant amount of growth. And of course, we worked together in both the UK and US. So good to see you again.
You too. I suppose we're kind of that rare group that's kind of lived and worked both sides of the Atlantic and in the market research industry, which kind of has been useful experience over the years.
Yeah, for sure. So for the audience, tell us a little bit about your career history, and then we'll kind of focus on what you've been working on the last couple of years since you moved back to the UK.
Yeah, so I've been fortunate in my career to work in quite a few different industries, 5 at the last count. Market research wise, I was at Toluna for a long time, about 14 years, and lots of different leadership roles, including product around the US, around the UK. Also worked in the marketing agency world at the start of my career. Those of you old enough will remember AOL bombarding the world with CDs in the mid-90s. That was partly my fault, in the UK at least. Worked in the IT services industry for a while. Flirted rather unsuccessfully with the music industry for many years. And the last 5 or 6 years, I've been working as an M&A advisor, primarily selling small SaaS businesses, mostly not in the market research industry, actually, but across a wide range of verticals, and speak to loads of founders who are kind of on that exit journey and thinking about what their future might hold.
That's awesome. All right, well, I'm excited to dive in because there's a lot of founders, of course, in our industry who are definitely interested in this key area. So let's start with something kind of punchy. In your opinion, what really creates long-term value for companies in this industry, but also beyond? Is it the technology? Is it innovation? Is it talent? Or is it something else?
Well, the market research industry is unique and the same in lots of different ways. We'll start with what makes it the same. I think there's the reality is that value is in the eye of the beholder, right? So what does value mean? Is it the value, hopefully, what your customers get from it, or your employees and stakeholders, as opposed to valuation, right? I think in terms of what makes a company valuable, just pure financial metrics are very consistent across industries. So it's absolute revenue, it's profitability, it's growth, but increasingly it's retention. I mean, whether that's a software business or whether it's a project-based business, which the market research industry is to a somewhat large extent. It's really about how you keep and grow customers. So I think if you have a great retention profile, this is what builds a long-term value. It means that your customers love you. It means that your employees are sticking around, probably becoming more expert and helping their customers grow. So I would say, the great measure of value is how cohorts of customers grow over time.
Yeah, that makes sense. And outside of kind of that area, are there other key metrics and performance indicators that those investors prioritize over others when looking at firms in market research or outside?
Yeah, so I probably speak to 100 to 200 founders a year, and they pretty much ask the same question. And in the software business or the SaaS world, I think you can also transfer it to the sort of non-software business. The thing that keeps coming up again and again is what's called net revenue retention. So that is that notion of a business growing even without adding extra new customers. So if you had 10 customers, are they worth double what they were the previous year? Profitability and and growth are very interesting bedfellows, right? In 2021, everyone was like growth at all costs. Profitability is sort of a bit of a dirty word, particularly in the software industry, but to some degree in any high growth sector. That's totally changed now. And the bar is much higher for investors. They want to see at least break even or path to profitability, solid growth, controlled growth, and in a market where you're solving a real problem. There's no point being like the 800th survey tool on Mike Stevens' Insight Partners list, the Insight Platforms list. The reality is there are loads of those companies. Do something different, something unique, and really add value.
Yeah, that makes a lot of sense. What kind of number do you put on kind of, unicorn style net revenue retention rate? What is that percentage that folks should be really aiming for?
Yeah, well, that depends enormously on the profile of the customer, or the client. So if you're selling to small and medium businesses, retention, those kinds of companies tend to churn. So in the market research industry, for example, you're probably not selling to rather small companies, right? They tend not to have market research budgets. You tend to be selling to. But certainly enterprises, mid-market, if you're over 120% net revenue retention, you're best in class. If you're selling to purely mid-market, anything over 100 is pretty good. And if it's below 90, 95, that means that you have a leaky bucket basically, and you have to win those new customers to keep growing as quickly as you would like to. And that is something that investors will dig into. And then just losing customers in general is perceived as one of the main reasons not to kind of invest a lot.
Yeah, that makes sense. We obviously talked a little bit about kind of SaaS models and net revenue retention rates and GRR and all those kind of great metrics. And, where you and I started was in very much market research, project-based research. And the industry's really had to pivot into more of a SaaS model. So would love to kind of hear a little bit more on, the advantages of SaaS offerings over traditional service-based kind of models, and particularly how that works here in market research.
Yeah, so I think this is a really interesting topic. So first of all, in my opinion, the market research industry is not, for the most part, well suited to the SaaS model at all, because the vast majority of the things that happen that make market research so great is because they're highly customized, or they're addressing a very specific problem in great depth, and that doesn't always lend itself brilliantly to kind of recurring revenue subscription model. So that part has been. Well, I've seen quite a few issues with companies who have tried to put the proverbial square peg in the round hole by transitioning their business to a subscription model from what was a project-based model. The reality is, I don't think I've ever seen a company do it totally successfully. My old company, Toluna, you're very familiar with, of course, because you worked there as well. We did that pretty well, but we actually started out as a tech company that started to build a panel. But even then, it was, there's still a big mix of services. Qualtrics is an amazingly successful business. 40% of what they do comes from services and sample purchasing and so forth. So the industry in of itself is not brilliantly suited for the large part to pure SaaS models. That said, there are some really interesting kind of license plus usage models. I've seen some companies be very successful with that. And I think ultimately you have to listen to what your customer is saying or your client, because if they don't, if you're selling to agencies like a market research agency or an ad agency, they don't want to pay a subscription. They need it, best service, best price. If you're selling to brands, they may be a bit more flexible, but it's really, you have to be careful not to try and shoehorn in the business model du jour into something that frankly doesn't fit what makes the market research industry so great, which is high EQ, high customization, and great curiosity.
Yeah, you're absolutely right. I think in my experience, and obviously Suzy is very much SaaS based, when working with those enterprises that you had kind of talked about, and that's our real cohort of customers, the key benefit for them is it can be quite cumbersome to raise a PO, get a project scoped, get it off the ground, and actually having that always on license enables them to be much more agile with their research. And so although it may take us a couple of months to kind of enable and help that brand understand the benefits of an always on license, once they're there, they can't kind of turn back. They are, delighted to be able to answer that CMO question at 5 p.m. on a Friday, come in on the Monday, have data already. So when it works brilliantly and to the benefit of the customer, not just the investors.
Yeah, no, I would agree, but that's because you started in that world, right?
Yeah, it would definitely have been much harder had we not started there. Yeah.
I think so. The other advantage, though, that it does give is budgetary certainty for the
Yeah.
client. They know how much they're going to be spending, and therefore things can be controlled. So that is a reason to move to that model. But I've seen it executed so poorly so many times that you do worry that people are trying to do it just because they think they should do it.
I'm sure. Yeah, exactly. Yeah, and on that kind of point, our brand clients call it research insurance. It's always there, so they can put it in for the year. They know they're not going to have their budgets cut necessarily. So it's like that security of always having the credits available to launch. So talk to me a little bit more about kind of how investors generally perceive the market research industry today, the TAM of the market research industry. Are there any misconceptions that you think they're seeing? And what kind of trends or shifts have you seen, particularly around 2024?
Well, I think there's obviously everyone talks about AI, and I think that AI, let's start there. I think that is the way actually the market research industry can benefit enormously, and it sort of falls into three groups. I think you've got the notion that you're starting to see investors look at AI in the research industry as, okay, is it optimizing operations or helping us be more efficient with what we already do? And the answer is undoubtedly yes, because parts of the market research industry are incredibly labor intensive. They're volume based and so forth, so it works quite well there. Investors are also looking at, are there adjacencies in the core business that can be done? So I mean, for example, can you use AI to build brand segmentation that was not there previously, brand tracking, for example. And then there's the third horizon, like, can it help us do something completely new that we weren't doing before, take a new product or business line? So investors are looking at all of those things. I think they're also, what was, when you and I started in the industry, a very tech, I don't say tech averse industry, but well, I can say that.
Well, a little, yeah.
The proliferation now of platforms in the industry focus on insights is amazing, actually. So clearly there is a lot of investment going into the industry. As an industry, I would say that it has a lot of emotional intelligence that you don't see in other industries, and I can say that with confidence, having worked in, I don't want to throw shade on any particular industry, but in other industries where you just don't really get that. And I think that sometimes leads to a more cautious approach in terms of growth, and that sometimes investors have to really buy into the story, and therefore you can if you can position yourself well, you can do incredibly well and attract lots of investment opportunities. What else could I say? Yeah, I think just going back to the thing that it's because it is a highly episodic industry, it's very reoccurring. They're quite often investors who are familiar with professional service models, whatever, tend to be better suited than pure SaaS investors in our experience. But I'm sure other people will have different views.
Yeah, for sure. It's not Slack. It's not tools that are kind of reoccurring on a daily basis. It definitely has a more lumpy kind of approach, but it definitely is reoccurring, as you kind of rightly say there. Those brands are still going to have to launch new products, create new ad campaigns, and build value for their consumers, for sure.
Yeah.
So what should leaders in our industry be aware of, to help them make their businesses more attractive to some of those investors? Are there specific red flags or green flags that investors look for?
Well, I think firstly, why are they looking to attract investment? Is it to grow? Is it to effectively exit the business? What are the motivations behind it? So I think the key thing is to understand a little bit about the investment landscape. So at one end you have sort of angels and sort of seed funds who basically put in small amounts of money into early stage companies. VCs are slightly different. They are, larger businesses tend to make sort of moonshots, and 2 out of 20 of their investments will pay off. They often look for larger addressable markets than kind of later stage because they want something to go very large. Private equity tends to come in later on. They're looking for profitable growth, not always, but for the most part. And you have some really interesting areas like family offices who tend to have longer time horizons than private equity and VCs. Actually, Toluna is owned by a family office, for example. And even things like search funds, which are, I won't go into too much detail, but these are companies, investment vehicles that basically bring in a new CEO if the founder is looking to retire, preserve their legacy, or even take a non-CEO role because they just don't like being CEO very much. Mm-hmm. So you have to look about what type of investor you want to bring on. And then it's not just about the money. I mean, the reality is that it's easier to get divorced probably than it is to get an investor off your cap table who you don't really get along with. So, the chemistry, the values that they have is important. Can they bring things beyond the money? Can they bring connections, expertise? Can they help with hiring? Have they done this before? There are so many reasons to really do your due diligence on them as much as them doing it on you. And that's something that I think that founders often sometimes stop a little short on, is actually it's a two-way street. You've really got to understand where they're coming from rather than just about you answering their questions about your business and where you want to go.
Yeah, which I'm sure can be really hard when lots of companies want to invest in you. It must be really difficult to not just say yes and instead actually have to kind of have that two-way interview in a way.
Yeah, it can be difficult to differentiate, frankly, between some of these investment funds. They are to the uninitiated pretty similar. Even to the initiated, they're pretty similar sometimes.
Yeah, for sure. I think what I love about market research is the enormous TAM that we work within. But I'm always surprised at how much of that TAM is still with the very, very large, more traditional incumbents. And there are hundreds of thousands of small and niche companies in our industry that are either tech or services based. So how can those kind of smaller and niche companies really stand out to investors in such a competitive field?
I think it's easier, less about investors, but just being successful as businesses themselves. I mean, I think it's easier now to become to punch above your weight, as it were. I mean, one example is a company that I'm involved with. I'm on the board of a company called Glimpse, which is an AI startup in the market research space. Their first big customer was HubSpot. Right? Wow. They're talking to the very large retail chains in the US. They've got the big CPG or FMCG, as we call them in the UK, companies working with them. And if I go back 10, 15 years, to really get on the radar of a Procter & Gamble or a Walmart or whoever it was, it required a certain, frankly, longevity of existence, it's much easier now to be able to get in front. If you've got something really compelling, you're solving a problem that you can articulate really, really well, then actually you're going to get a seat at that table. The downside is that I think consumer insights buyers, the senior people at the companies I mentioned are literally bombarded day in, day out with new solutions. And that was not really the case, I would say, 10 years ago. And therefore, the smart insights buyer who can quickly kind of evaluate and figure out if it works is also going to be successful on the client side. So I think if you can do that, then actually you'll attract investment. Regardless, you won't need to go out seeking for it. You'll be approached. And private equity and VCs are very good at outreach anyway. They do a lot of it. So you will certainly be being a bit bombarded, I suspect, by venture capital and by private equity, depending on where you are in your kind of company life stage.
Yeah, you raise such a good point. I think there's unfortunately a lot of tools out there in market research right now that are tools looking for a problem to solve. And I think companies like Glimpse, and kudos to Neil, former colleague of ours, who has done phenomenally well because he has a well-articulated problem that his tool is trying to solve rather than a tool looking for a problem to solve, which I think is what we see too often.
Well, and I'll give a plug to Mike Stevens from Insight Platforms for that, actually, because if you go on there and you search for whatever sentiment analysis or survey tools, there are literally hundreds now, and he's done a pretty good job of curating and segmenting that. And Seema and Patrick building the ResTech landscape. These are signs of sophistication in the technical landscape in market research that was not there a few years ago. So the future is bright, but it's certainly getting more complicated than it was.
Yeah, for sure. Well, Mark, we could talk all day. I'm sure each of those questions I asked could have been an entire podcast on their own. So thank you so much for your insight. This was fantastic. And would love to catch up with you again soon.
Thanks,
Bye.
Casey.
Thanks for joining MRII's Insights and Innovators podcast. Be sure to subscribe and listen to all of our podcast episodes and visit us at mrii.org for more insights for market research professionals.